This is Sandeep Anand with Sand Compounding. I'm going to introduce you to a legendary American investor, author, and an entrepreneur. He is John Bogle. He founded Vanguard Group, which is almost the largest mutual fund advisory and second largest probably in asset under management. The total assets under management with Vanguard Group is almost whopping $5.3 trillion, which is more than the economy of Japan GDP. Now, John Bogle has been a strong proponent of low-cost or dollar-averaged index investing, and he has touted this to be a foolproof mechanism of investing for common investors. This is primarily focused on investing in index funds consistently over long periods of time. John Bogle has immensely contributed towards investing field, and he is not a billionaire. He gave away his ownership in Vanguard so that the shareholders could hold the holdings in mutual funds. John Bogle has also written a lot of books, the most prominent one being the Little Book of Common Sense Investing, which was even recommended by Warren Buffett as one of the best reads for any common investor. John Bogle recently passed away, and it's sad, and his contributions towards the investing world has been invaluable. And here is a video of John Bogle which has some good investing principles. Take a look.
First, let me differentiate between the active managers. Let's call him a stock picker. And for each good stock picker, of course, is a bad stock picker, but no way around these things. And then there's asset allocation. How much do you want in stocks and how much do you want in bonds? To me, that is by and large a buy and hold proposition. Don't do something, just stand there, almost no matter what happens, and maybe no matter what happens. For example, even this 50% decline, you ended up with more money 7 years later, from 2007 to 2014, if you just stayed in and just taken your lumps, and it came back if you were in an all market index fund. So asset allocation is a little different, but there's one thing that is the same. Please don't let anybody forget this. If you're smart enough to reduce your allocation to stocks and increase your allocation to bonds, somebody else is reducing their allocation to bonds and increasing their allocation to stocks. Time is your friend, but if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this. When the market is low, it's low because people like you are really worried. And that's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. In other words, if you're discouraged and selling at the low and aggressive and buying at the high, your money isn't going to last very long. We seem to come down to for most investors, an idea that something like 65% stocks, 35% bonds is an intelligent allocation. Now, we know stocks are almost certain to do better in the long run, just because of the nature of the capital markets. So we've already said we want to do something to give us a little anchor to windward, dry powder, call it what you will, to protect you against behavioral mistakes, and to give you some stability in your account, and usually more income, although not much more today. So if it's 65-35, and for whatever sound reason, not emotional reason, you can come up with, and the market looks substantially overvalued, don't worry about it if you think it's 20% overvalued or 25% or undervalued by the same amount. But if it seems to get out of line by a substantial amount, take the 65 to 50. Take the 35 to 50 and be 50-50. But the idea of an all or nothing approach, well, I sold all my stocks yesterday, you're going to have a long, hard investment lifetime. Who can do that?